The Bank of Canada recently surprised many by cutting its key interest rate. This unexpected move sent ripples through the Canadian economy, leaving many wondering about its implications for their wallets. Was this a sign of economic trouble on the horizon or a welcome relief for borrowers feeling the pinch? To understand the significance of this rate cut, we need to first understand what it is and why it matters. In simple terms, the Bank of Canada's key interest rate influences the rates that commercial banks charge on loans and offer on savings. When this rate goes down, borrowing becomes cheaper and saving becomes less rewarding. This rate cut, while unexpected, was not entirely out of the blue. The Bank of Canada, like many central banks worldwide, is tasked with keeping inflation in check while fostering economic growth. When the economy shows signs of slowing down, a rate cut can be used as a tool to stimulate borrowing and spending. The interest rate set by the Bank of Canada acts as a benchmark for financial institutions across the country. When the bank lowers this rate, it becomes cheaper for banks to borrow money, and those savings are typically passed on to consumers and businesses in the form of lower interest rates on loans and mortgages. This ripple effect can have a significant impact on anyone with a mortgage, line of credit, or loan. For example, a lower interest rate on a mortgage could mean hundreds of dollars less in interest payments each year. Similarly, businesses looking to invest or expand might find it more appealing to take out loans at lower rates. However, it's not all positive news. Savers, on the other hand, might see their returns dwindle as interest rates on savings accounts and GICs, or guaranteed investment certificates, adjust downwards. This can be particularly concerning for retirees who rely on interest income to supplement their pensions. The most immediate and tangible effect of this rate cut is the reduction in borrowing costs. For Canadians carrying debt, this could offer some much-needed breathing room. Lower interest rates on variable rate mortgages, for instance, translate into lower monthly payments. Similarly, those with lines of credit or personal loans will also benefit from reduced interest charges. This could free up cash flow that can be used for other essential expenses, or even channeled towards paying down debt faster. However, it's important to remember that the actual impact on individual borrowers will depend on a variety of factors, including the type of loan, the terms and conditions, and the lender's policies. The rate cut is particularly significant for Canadians with variable rate mortgages, as their mortgage payments are directly influenced by fluctuations in the Bank of Canada's key interest rate. A lower rate could provide some relief for homeowners who have been feeling the squeeze of rising housing costs and the overall cost of living. However, it's important to remember that even a small decrease in interest rates can have a significant impact over the long term. Homeowners should resist the urge to overextend themselves financially and consider using any extra savings to pay down their mortgage principal faster. Moreover, this rate cut might encourage more Canadians to enter the housing market, potentially driving up demand and prices. This could lead to renewed concerns about housing affordability, particularly in major urban centers. Section 5. the potential downside for savers. While lower borrowing costs are undoubtedly welcome news for many, the flip side of the coin is the impact on savers. With interest rates on savings accounts and GICs already at historic lows, this rate cut could further erode the returns for those who rely on interest income. This is particularly concerning for retirees who depend on their savings to generate income. Lower interest rates mean they will have to dip further into their nest eggs to maintain their standard of living, potentially jeopardizing their long-term financial security. Furthermore, the low interest rate environment can discourage saving, especially among younger generations. When the returns on traditional savings vehicles are minimal, it can be tempting to prioritize spending over saving, potentially impacting their ability to reach long-term financial goals. Section 6. Consumer confidence. A boost or a bust. The Bank of Canada's decision to cut interest rates can be seen as a signal to consumers about the state of the economy. On the one hand, it might be interpreted as a sign that the economy is not as robust as previously thought, potentially leading to a decline in consumer confidence and a pullback in spending. On the other hand, lower borrowing costs and the potential for increased economic activity could boost consumer confidence, leading to increased spending and investment. This is particularly true if consumers perceive the rate cut as a sign that the Bank of Canada is taking proactive steps to support economic growth. The ultimate impact on consumer confidence will depend on a variety of factors, including overall economic conditions, job security, and wage growth. Section 7. The generational divide. The impact of the rate cut is likely to be felt differently across different age groups and income levels. Younger Canadians, particularly those saddled with student debt or struggling to enter the housing market, might welcome the relief from lower borrowing costs. However, older Canadians, especially those who rely on interest income from their savings, might be negatively impacted by the lower returns on their investments. This could exacerbate existing inequalities and create challenges for retirees trying to make ends meet. Furthermore, lower interest rates can fuel asset price bubbles, particularly in the housing market. This could benefit those who already own assets, typically older and wealthier Canadians, while making it even more difficult for younger generations to get a foothold. Section 8. The long view, inflation, and the future. The Bank of Canada's decision to cut interest rates is not without risks. One of the primary concerns is the potential for inflation to rise above the bank's target rate of 2%. When borrowing is cheaper and money is more readily available, it can lead to increased demand for goods and services, potentially driving up prices. While inflation is currently under control in Canada, it remains a key concern for policymakers. If inflation were to spiral out of control, it could erode purchasing power, reduce consumer confidence, and ultimately harm economic growth. The Bank of Canada will need to carefully monitor the impact of this rate cut on inflation and be prepared to adjust its monetary policy accordingly. Section 9. A balancing act. The Bank of Canada's recent interest rate cut is a double-edged sword. On the one hand, it offers much-needed relief for borrowers, potentially stimulating economic activity and boosting consumer confidence. On the other hand, it could further erode the returns for savers, fuel asset price bubbles, and increase the risk of inflation. The long-term impact of this rate cut remains to be seen. The Bank of Canada faces the delicate task of balancing the needs of borrowers and savers while navigating the complexities of the global economy. Only time will tell whether this rate cut will ultimately prove to be a boon or a bane for the Canadian economy.